For more on the Fed and the markets, we're joined by Luke Ellis, CEO of Man Group, a global active investment firm with $138 billion in assets under management, and Ken Rogoff, professor of economics at Harvard University. Welcome to you both. Good to see you here.
Good morning.
Esteemed people we have.
Yes, exactly. It's a very prestigious table we have this morning.
Feels
Ken,
that way.
So we have it there. Central banks still tightening, maybe coming toward the end. Maybe the economy has been more resilient than perhaps anticipated. And maybe one of the takeaways I thought from Powell yesterday was he's at least open to the prospect that the economy can prove a soft landing is possible under certain conditions. What's the policy and growth interplay that you see right now at work?
Well, we're clearly getting to a point where you could play it either way. When you're the Fed, there's, take more inflation risk, take more recession risk. I think they're still going to go a little higher for sure. But then you reach a point, I think, where the economy still looks pretty good, the labor market. The inflation is not as good as they'd like. So I think whereas like 6 months ago I would have said pause sooner rather than later, they should get to 4 or 5% and then pause so that you don't have a big recession. I think they probably see the risk of a big recession a lot smaller, but the risk of inflation lasting a long time is bigger. So I would listen to what he said, not overreact to, and inflation reductions on the way, down to 3.5% or 4%. Right. But not down to 2.5%.
You just can't extrapolate that aggressively, I guess. And Lou, from an investment perspective, tactically, it's very evident that in aggregate, people were underexposed to risk and to equity markets, for example, coming into this year. Nothing has really gone too wrong in the near term. Where are we besides that tactical trade? Do you think that this was any kind of a green light for risk markets?
Look, I think you have to think of all of this in a broadly tactical way compared to the last 10 years. We're going to trade big, wide ranges. What we've got is, at the moment, there's good news. We would see inflation coming down to a 2 handle in the second half of the year. That's going to make the market feel great. But I don't think you see the Fed cutting rates. And at some point, if they're cutting rates, it means we've got a real recession. There's no evidence of that, and we've still got lots of wage inflation. If they're not cutting rates, at some point the market's going to go, oh, blimey, we're in the wrong place here because we're staying at 5%, and then you're going to get a noticeable sell-off in the second half.
And what about what's going on in the rest of the world here as well? Of course, we talk about how the Fed's ahead of Bank of England and the ECB. And again, we've seemed to have sidestepped for the moment a bad European recession as well.
For the moment.
Yeah.
I think, look, the poor old Bank of England, they're sitting there with 10% inflation and the recession started.
But
if you think the Fed had a tough time.
Luke, are you in the oh blimey category then? That's what I'm trying to. It sounds like you. Are you on the glass half full or glass half?
In terms of recession?
I'm in the tactically long risk assets. They're going up. Enjoy it while they're going up. I think we have another big leg down coming later on when we start to have to deal with the fact that we haven't dealt with wage inflation.
Right.
Services wage inflation.
How are you going to know then, as a trader, when that you're supposed to get? This goes with timing game. If there's the what do you call it, the oh blimey moment, it would be good to know about the oh blimey moment before the oh blimey moment happens, right?
Yeah. Well, look, there's a point where the equity markets, bonds have either got to accept that the Fed is not going to cut, in which case you get rates higher, and that's the oh blimey moment, or it looks like the Fed is cutting, but they're only cutting because you've got a significant worsening in the economic situation, in which case it's bad for earnings. So the equity market needs to look to the bond market for the oh blimey moment. But in the meantime, enjoy risk.